Ladies and gentlemen, by now you've heard whispers that the US dollar is under pressure. But let me be very clear right from the start. This is not a warning. This is not a forecast. This is a full-blown monetary stress event already in motion. And the scary part, most people still don't see it, because when the dollar falls, it doesn't fall gently. It takes entire portfolios, pensions, bond markets, and global confidence down with it. And the lower the dollar sinks, the more people wake up one morning realizing they're the ones holding the bag. Let's start with the uncomfortable truth. The US economy today is not powered by productivity. It's not powered by savings. It's not powered by real growth. It's powered by debt, and more specifically, government debt. The entire system is starved of capital, especially Washington itself. And now, instead of fixing the problem, policymakers are reaching for the most dangerous lever of all. They want to loosen banking regulations. Why? Because they need banks to absorb more US treasuries. Listen to the logic being sold. The post-2008 regulations were too tight. They've put the financial system in a straitjacket. Translation? Let Wall Street off the leash again. And we all know how that story ends. This is exactly how the 2008 housing collapse began: lower capital requirements, higher leverage, and blind faith that nothing could go wrong. The plan is simple and reckless. Lower capital requirements for banks holding treasuries. Make US debt look safe on paper. Force Wall Street to buy it. But here's the truth nobody wants to admit. The problem isn't the banks. The problem is US fiscal policy. There is no spending brake, no discipline, no political will to stop. Between July and September alone, just 3 months, the US borrowed over $1 trillion. That's not stimulus. That's not emergency spending. That's a burn rate. Tariff revenue? Not even close to enough, and investors know it. Lending to the US now feels like playing musical chairs with sovereign debt, hoping the music doesn't stop while you're still holding bonds. And now the world is starting to say it out loud. A European ratings agency, Scope, just downgraded the United States from AA to AA-. Sounds small, right? It's not. Credit ratings aren't just letters, they're global trust scores. And this downgrade sends a brutal message. The US is no longer the gold standard of creditworthiness. In fact, countries like Sweden and Norway are now considered more reliable than America. Let that sink in. The US is now just one step above China, except China has capital controls. America doesn't. Because the lower the US falls in credit rankings, the harder it becomes to lure investors. And the only way to compensate? Higher yields. Which means higher interest costs, faster debt growth, more pressure to print money. It's a vicious cycle. And this is why even Warren Buffett is openly worried. Yes, that Warren Buffett, the ultimate pro-America investor. Even he admits the biggest risk isn't stocks. It's the currency itself. Because when governments debase their currency to survive fiscally, bondholders get wiped out in real terms. You might get paid back nominally, but your purchasing power is gone. Here's how it hits everyday people. As the dollar weakens, imports get more expensive, supply chains inflate, prices rise everywhere, from Costco to Walmart, to your rent, groceries, and energy bills. You don't see it called a tax, but it is. Major banks are already positioning. Some are openly forecasting a 3% dollar decline by end 2026. Others say 5% drop in just the first half of next year. And here's the Fed's nightmare scenario. Other central banks aren't cutting rates at the same pace. Thanks to tariffs and global inflation pressures, the world is no longer moving in sync with the US. America needs rate cuts to support debt and prop up stocks. But sacrificing the dollar is the price. Now let's talk about the real wild card, Japan. This week, the Bank of Japan is expected to hike rates possibly to 0.75%, the highest since 1995. Sounds tiny? It's seismic. Why? Because it threatens the most powerful trade in global finance, the yen carry trade. For years, investors borrowed cheap yen and poured it into higher-yielding U.S. assets. Double win. Cheap funding, strong dollar. But that trade is unwinding. The yen is strengthening. Rate differentials are collapsing. The spread between U.S. Treasuries and Japanese bonds has dropped from over 4% to 2%. That's massive. And once that incentive disappears, money goes home. Back to Japan. Since 2025, the yen has already climbed sharply. And if Japan hikes again, or worse, hikes multiple times, the carry trade collapses completely. Some estimates say Japanese rates could reach 1.25%, even 2.5% if inflation stays hot at that point. U.S. assets face a liquidity vacuum. Bond yields rise. Equities crack. The Fed loses control. We're already seeing it. Tech valuations are so stretched, they're held together by cheap money. Take Oracle, down nearly 50% from its peak. Investors are questioning whether these companies can even refinance their debt in a tighter global environment. Data centers aren't cheap. AI isn't cheap. And when global capital leaves the U.S., financing dries up fast. The Fed could cut rates to 0 or below, and it wouldn't matter. This is now about supply and demand, not policy. While the U.S. scrambles, China is doing the opposite. They're exiting dollars, and they're moving into real money. Gold. China's treasury holdings have been falling month after month. In 2008, they helped absorb U.S. debt. Today, there's zero incentive. Sanctions, tariffs, tech bans. Holding your rival's debt makes no sense in economic warfare. China's gold strategy. Officially, China says it bought 25 tons of gold in 2025. Unofficial estimates, 10 times that. Real reserves may exceed 5,000 tons, possibly over 10,000 tons. And China isn't just buying gold. They're buying gold mines. Brazil, Ecuador, Latin America. State-linked companies are locking down supply chains. Because controlling gold production means controlling financial influence. Breaking the dollar system. China is building gold ETFs stored inside China. Not New York, not London. That matters. Because Western gold ETFs funnel capital into Western financial systems. China's model does the opposite. Pulls capital toward Shanghai and weakens Wall Street's grip. Even a gold embargo wouldn't stop it. Just like rare earths, the West is already behind. So here we are. The dollar is weakening. Japan is tightening. China is stacking gold. This isn't chaos. It's rebalancing. And it raises two massive questions. Will Japan's rate hikes accelerate a U.S. market breakdown? And will China continue buying the world's gold mine by mine? Drop your thoughts in the comments. If this breakdown helped you understand what's really happening behind the headlines, smash the like button, subscribe to the channel, and stay with us because the next phase of this monetary shift is going to shock a lot of people. Stay sharp, stay safe.